Yeah, hello everyone. It gives me a great pleasure on another session on markets and market outlook and equities in this session. It is a pleasure to introduce Shibani Kurian, Fund Manager and Head of Research for Kotak AMC. And in this session, we would be covering the outlook on certain sectors and the way forward. And also, we'd like to hear from Shibani what would be the views in terms of the upcoming budget as well. So my first question to you, Shibani, is we can start with the automobile industry to get started. And my question to you would be that how big is the India automotive market and expected growth rate going forward? And what do you really see are the key challenges facing the industry? Over to you.
Thank you, Aditya. A pleasure to be here. So as we start on our discussion on the auto segment as such, so if you look at the automotive market in India, in terms of its share in India's manufacturing GDP, automotive segment has a fairly large portion. And in terms of the overall India's GDP, the segment itself would be about 6 to 7% of GDP. Now, what we have seen in the sector over the last few years is that the sector has gone through a long period of lull. But now, if you look at what's incrementally changing in the sector is one, demand growth is coming back. Also, the replacement cycle is kicking in because for a long period of time, you have not seen that replacement cycle. And therefore, if you look at most estimates believe that growth in the auto sector as such should come back after this period of lull. Now, typically what expectations are looking like at this point in time is that if you look at real GDP growth in India in the range of say 6 to 7%, given the kind of demand tailwinds that are there in the sector should outpace the GDP growth outlook. Within this, the growth is incrementally picking up faster in the passenger vehicle segment. What we have seen essentially is premiumization, and therefore the top end of the passenger vehicle segment, specifically the SUV space, has seen significant uptick in terms of demand. Also in the CV space, we have seen that the LCV, as well as now incrementally even the tractor segment is starting to show improvement in terms of demand picking up. Where demand has been lagging has been essentially the two-wheeler segment. And their growth has still been slightly lower than what we have seen in the passenger vehicle segment. And this is primarily because of the fact that a lot of the incremental demand for two-wheelers comes in from the rural space. And post-COVID, the demand recovery has largely been driven by urban segment and rural has been lagging. And at the margin, however, that also seems to be undergoing some amount of change, and therefore rural recovery should start to pick up pace as well. Now, if you look at what the sector has gone through over the last few years, sector has seen significant amount of challenges and headwinds, and all of that has essentially impacted growth. So structurally, what has happened post-COVID specifically is that there has been a supply chain disruption, and because of which there has been shortage at the component level, and therefore chip shortage is something that we hear often, and that has something really impacted the overall production capability of many automotive companies in India. The second factor has been that with commodity costs going up, there has also been high input cost pressures that most companies have faced. And that has resulted in companies taking price hikes over the last few years. And therefore comes the question of whether affordability gets impacted at a point of time, given the fact that many companies, especially across segments, have taken price hikes. This has also been accompanied by increase in fuel prices. And overall, the sector itself has seen a shift away from the traditional ICE powertrains to multiple powertrains, which include, your electric vehicles, hybrids, etc. So all of these have meant that there have been various disruptions in the sector, and there have also been a fair amount of challenges. Now, if you look at all these challenges that I mentioned, in my previous comment, some of these challenges seem to be easing at the margin. For instance, the supply chain issue, which got accelerated because of COVID and China shutting down seems to be abating at the margin. Now, we are not back to normalized run rate in terms of how the supply chain should ideally move, and availability is still a challenge. But at the margin, you are seeing that things are improving. Similarly, for commodity costs and input costs, with pressures coming off at the margin, it does believe that companies are now better placed to manage their input cost pressures. And crude oil prices have also come down. So therefore, the sector which had seen significant amount of headwinds at the margin, things seems to be getting better for the sector, with demand coming back, as well as some of the structural issues getting sorted out as well. Over to you, Aditya.
No, I think it's thanks for the input, and I think you covered a couple of perspectives on the auto sector, and I think especially the things post pandemic as well, and I think these are really valuable inputs. So one of the questions which keep coming from clients as well, and when in my interaction and when we're talking to clients, is that what also would be, in your view, the key segments within this industry and the growth opportunities for the same? That's one way. And I kind of, when you know the segments, maybe it's very easy to ideate how you want to kind of allocate your portfolios. And so I know if you feel any kind of segment or any kind of there are several segments within the auto sector you feel would be doing well going forward. And maybe if I have to add maybe another question to this, and then we move to the next one, is do you expect some SOPs coming in the union budget for this sector as well? Over to you.
Sure. So when we look at the key segments, there are essentially 3 or 4 categorizations that we can do for the automotive space. One is the passenger vehicle segment, which is essentially the 4-wheelers and cars. Second is the 2-wheeler segment. Third is commercial vehicles. And within that space, you can look at tractors as well. So broadly 3 large segments and then a sub-segment of tractors. So when you look at the industry, and let's start with passenger vehicles as a segment. Overall in India, I think structurally the key driver for demand is the fact that despite the growth that you've seen over a long period of time, penetration levels in India are very, very low where passenger vehicles are concerned. So if you look at the data for India, for instance, if you look at per 1,000 people in India, the number of cars is only about 23. So essentially, as per capita income continues to rise, structurally, there is a case for growth where the passenger vehicle segment is concerned. And therefore, under-penetration is going to be a driver. And within that space, we've also seen premiumization pick up, which means that overall, while volume growth is strong, value growth also starts to improve over a period of time. Now, second is the 2-wheeler segment. Now, again, in this segment, you have seen that, structurally, there is a rise in terms of per capita income, which drives growth and demand. Secondly, in the 2-wheeler segment, if you look at penetration levels, with increasing participation of women in terms of workforce, or women, in terms of literacy, etc., and mobility increasing, there is a demand coming in from the segment, which is essentially the women users or the women riders. And therefore, that is also driving demand structurally. And again, penetration levels are such that there is a leeway for growth where 2-wheelers are concerned. And finally, in the commercial vehicle segment, the commercial vehicle segment is essentially driven by industrialization and infrastructure development, both of which we have seen starting to pick up, with the government policy focus moving towards investment-led GDP growth, and therefore segments such as roads, railways, ports, etc., adding to the overall growth. Now, within these 3 large segments, our preference order at this point in time, given demand and supply dynamics, is passenger vehicles, followed by 2-wheelers, and then the commercial vehicle segment. Now, as we were discussing initially, what we are seeing in the passenger vehicle segment is that the demand seems to be coming back in a big way. There is premiumization, as well as the fact that inventory levels in the system are fairly low. Of course, there are issues because of supply chain problems and production issues as a corollary to that supply chain issue. But overall demand levels continue to remain fairly strong. A second segment in the 2-wheeler space, with incremental recovery on rural and improvement in terms of rural wages, as well as government spending on the rural side, which is likely to pick up So this could be the second segment where growth starts to normalize. And then finally, the commercial vehicle segment, where of course you have seen improvement in growth, but we believe that in terms of pecking order, our preference would be for PVs, two-wheelers, and then commercial vehicles. Now, so if you look at, from the budget perspective, while we don't expect anything directly for the sector as such, but what we believe is a key to watch out for is what steps the government takes in terms of reviving rural economy and rural demand. Now, post-COVID, India clearly has seen a K-shaped recovery, where urban has outpaced rural now for the last few years in terms of demand recovery, and rural has been lagging. Incrementally, we are tracking some data points on the rural sector, which include rural wages, the Rabi crop sowing, cash flows, etc., which seems to suggest that rural economy seems to be bottoming out. However, for the demand to recover in a big way, you would need that incremental support from the government come through in the budget. And therefore, if that comes through in terms of their allocation to various rural schemes, etc., that would be positive for the sector as a whole, especially the two-wheeler space. Over to you.
Yeah. Thank you, Shani. That was, I think, a very valuable input covering the auto sector, and I'm sure viewers would appreciate the same. And which makes us go to the the second sector with like to talk, and which is basically industrial and capital goods. And I think with capex and all, obviously this is a sector which which is being closely tracked as well. So my first two questions, and I kind of combine the two, is that so if you look at the capital goods market today in the country is approximately worth $43 billion US, and it consists approximately of 10 subsectors. Where do you see this industry going in the next 3 to 5 years? And if I were to add just another question to this as a add-on, is that among these 10 subsectors, what will be the top 3 subsectors contributing to this growth, and what would be the growth drivers per se? Over to you.
Yeah, you've hit the nail on the head. So over the last few years, I think what has changed from a policy perspective, which is showing through in terms of how investments have behaved in India, has been that the government believes that India, which is predominantly a consumption-led economy, should see broad-based growth, and therefore investments are extremely important. So what's clearly been happening is that when you look at investment, there are 3 key segments to investments. One is public capex, which is nothing other than government spend in terms of infrastructure. The second is private sector capex, and third is household capex, which is essentially rural investments in real estate, beg your pardon. So what has helped manufacturing and capital goods as a segment has been the fact that the government policy focus has been towards increasing the investment proportion in the overall GDP pie. Now, also, if you look at structurally, manufacturing has been benefiting from a few other global themes, and what we've seen in terms of what's happening with China, with supply chain shift away from China. There has also been signs of improvement in growth where industrial consumables, consumer durables as a segment is concerned. Now, obviously, core industrial capex is recovering, but it's a gradual recovery. And the incremental support that you need from the private sector is coming in, but again, it's a gradual recovery that is taking place. Our belief is that from here on, the overall capex cycle should pick up pace, of course, supported by government capex, but incrementally private sector capex also coming through. And therefore, this is a segment which can actually outpace GDP growth in the medium term. And therefore, the demand for capital goods also should see fairly strong growth in the medium term, outpacing the overall GDP growth that you're seeing in the country. Now, from the government focus, if you look at various schemes that the government has been running, including their focus on Atmanirbhar Bharat, means that the overall visibility of growth in the segment remains fairly high, and also that they have put out a target in terms of how they are seeing spending on the investment side and facilitating long-term spending, which are all key positives in terms of the growth of the sector. Now, as you rightly pointed out, when you look at the entire capital goods space, there are, these few key subsegments, which are the 10 subsectors that you mentioned. Now, within that, what we believe is sectors such as heavy electrical equipment, process plant equipment, earth moving, mining, which are all linked to infrastructure development, should likely be the top sectors contributing to this growth. And therefore, as long as the investment on infrastructure continues, the trend in these sectors should also remain fairly robust. The other thing that I also wanted to point out is that incrementally, when you look at investments are also taking place in new sectors, which should also drive growth over a period of time. So sectors, for instance, like renewables, battery storage, green hydrogen, even the entire policy focus, which is shifting towards indigenization of defense, which is attracting investments. All of that means that all these segments, apart from the traditional investment or traditional capital goods segments, would also see fair amount of growth and demand. But yes, this is a space where we are fairly excited about in the near to medium term. And we believe that structurally things are changing for the positive for this sector. Over to you.
Yeah, thank you. I think you covered important perspectives on the industrial and capital goods, and what are the key sectors going forward. And which brings me to the next question here, is that one of the things which is really closely tracked in this sector is the FDI, or the foreign direct investment trends. So how do you see the FDI trends in this industry, and among the key sectors which you highlighted earlier, do you see the same top 3 sectors would continue to get a fair share of the FDI, or is that something which could change in favor of other sectors? That is one perspective that would be helpful. And again, I would like to add that anything, what our viewers can expect from the budget for this sector. Over to you.
Yes, thank you. So if you look at the budget, and maybe I'll talk a little bit about the policy changes and budget, and then weave that into where we are expecting a lot more trend in terms of FDI inflows and segments which benefit from the same. So if you look at the government has been fairly steady in its policy of increasing the share of manufacturing and investments in the GDP. So if you take a step back, what's really started this entire trend was the cut in terms of tax rates and corporate tax rates, specifically for setting up of new manufacturing units in India, which was brought down to 15%. And this made India a level playing field with the rest of the emerging market countries in terms of attracting investments into the country. So that was the start. Post that, of course, the PLI scheme, which is a production linked incentive scheme, which was announced across 14 sectors, which has also led to considerable increase in outlay where infrastructure development is concerned. So our overall view is that from a budget perspective, the policy focus and the policy direction will remain pretty much the same. We do believe that outlay for capital good and infrastructure will see significant growth, as we have seen in the last few years. And therefore, maybe even announcement of more PLI schemes is something that we could actually watch out for. So if you look at what you asked in terms of FDI trends in the sector, clearly now incrementally we are seeing that foreign capital good manufacturers are interested in setting up capacities in India to capitalize on the growth opportunities. There are also trends where people want to, kind of diversify their exposure away from China, and that's actually a reality today, which means that given the tax structures in India, as well as the focus on ease of doing business and incrementally policies also changing in terms of allowing people to come in, there is an opportunity, or at least an alternative that is available to a lot of the foreign manufacturers in terms of setting up capacities and investing in capacities in India. So what we think that the opportunity set is fairly large and the investment environment is quite favorable. So within the sectors which are, seeing FDI, of course, across sectors you are seeing FDI flows. What we believe is that if you look at segments such as heavy electrical equipment, process plant equipment, earth moving, mining, which again are sectors which are likely to see larger growth opportunities, should attract maximum share of this pie which could come into India. So again, railways, defense, all of that means that these are segments which could see incremental investments or flows coming through where capital goods infrastructure is concerned. Over to you, Aditya.
Yeah, thank you so much, Shibani. As usual, very valuable inputs, and I'm sure it will be of a great use to our clients and users alike. Um, um, so we covered two sectors, and I think which takes us to the third sector, which we'd like to have some perspective of yours. And this is typically the traditional being in Bangalore, IT sector and services. So I'd like to again break this up into three, four key components so that it's easier to address the key queries which we'd like to know from you. So my first question would be in terms of, if you really look at India's IT industry, it broadly can be divided into four main segments, and these are IT services. This is business process management. You have software products. You have and then engineering services, and then the fourth one would be hardware. How do you see each of these sectors, moving up in the next 3 to 5 years? And within these, 4 or 5 sectors, would you be bullish on, one or two sectors which you feel would be doing good going forward? Over to you.
So IT is obviously a very interesting sector. If you look at the IT sector and the four key segments that you mentioned in terms of services, business process management, software products, and engineering, and then we'll come to hardware. But within these four segments of services, clearly the focus is on IT services as a growth driver, and that's a predominant driver of the overall pool that you see in terms of technology and technology spends worldwide. And that's where India clearly has an edge and a share. So what's been happening and let's start with IT services in that space. So what's been typically happening specifically after COVID is that the industry saw a shift in terms of how companies were approaching their overall digital transformation journey and digital adoption. Now, typically, most companies had already embarked on digital adoption, but with COVID, they just brought it forward and said that we need to accelerate the entire digital services space. So therefore, adoption of digital cloud migration, etc., is something that has become much more a reality today than what it was, say, 3-4 years ago before COVID struck. And this itself can provide strong growth structurally for the industry over the medium term of the next 3 to 5 year period. Now, while this entire digital transformation story remains fairly intact, what we also need to understand is that there are macro challenges which most large economies of the world today are facing. Now, for IT services as a sector, the two large countries which contribute to demand is the US geography as well as Europe. So these are the two large countries. And both these countries are going through a period of macro uncertainty. Now, so far, when we talk to a lot of the companies, the feedback that we get in terms of how their clients are behaving is that while clients are worried about the macro uncertainty, they have still not pulled back in terms of their overall IT spends. And therefore, there has been no deal cancellation, etc. And deal wins are taking place. Of course, there is a fair degree of uncertainty. Now, typically, client budgets for the year are decided in the month of January. And therefore, once those budgets get decided, we get a better sense of how growth outlook for the sector, at least for the near term, should pan out. But structurally, we believe that the entire opportunity pool because of digital transformation remains intact. Near term, you could see some macro challenges which could lead to revenue growth slowing down. And therefore, near term, companies facing some amount of headwinds. Also, what we need to look at, in terms of the IT services space is vendor consolidation. Typically, when you see, the overall deal pie moving from discretionary spend to cost takeouts or, trying to reduce costs, companies try to focus on few vendors rather than spread it across many vendors. So that's also a trend that we will need to watch out for where the next year is concerned. So that's in a nutshell where IT services is placed. Medium term, we believe that the demand outlook remains strong. Near term, there are challenges that the sector would have to undergo. Now, in terms of some of the other spaces that you mentioned, say, for instance, BPM or software products, again, structurally, the outlook remains fairly strong. So, for instance, in the BPM space, the entire enterprise focus on user experience, user interface, etc., is all translating into robust spend. And therefore, therefore, there are these integrated deals that are taking place. Near-term macro challenges could mean that some of it slows down, but over a period of time, this is something that would continue. Now, within that entire space, again, something that we like structurally is the engineering services segment. And therefore, we believe that the kind of spends that companies will again do over a period of time in the medium term, there is fair amount of growth opportunity, especially when engineering services as a segment is concerned. So, if you look at Indian IT sector as a whole is predominantly driven by IT services. And therefore, near term, there are some macro headwinds. But structurally, I think the journey that most companies have embarked, where their entire digital adoption journey is concerned, should continue in the medium term. Over to you, Aditya.
No, I think interesting perspective again. Clearly, if I can infer from what you're saying, I think IT services is going to lead the pack. I think that's a fair enough conclusion. While I could say that other services as well would not be far behind. They should also attract the fair share of growth as we move forward. And I think digitization is clearly a mandate, which the current government has initiated. Across, whether you're looking, especially in the financial space, the entire digital infrastructure is a backbone. So I think, so to conclude, yeah, IT services seems to be leading the pack, and with others not far behind. Which brings us, to the kind of the next question is that India generally has a low-cost advantage in this sector, and if I'm right, China has been enjoying that for a very long time now. How long do you foresee this as a competitive advantage, especially in the wake of, if I'm getting my data right, if looking at China, that the cost arbitrage or the low cost advantage slowly seems to be kind of going away. So do we go the China way over the longer run? That's one question. And I have to add one more to this, is that if you see larger players with a wider range of capabilities seemed to be doing much better. And you have so much innovation happening in India, startups and all. So do you see the industry consolidating, or would you foresee, certain startups becoming fairly large in the future and outpacing the larger rivals as of today? Over to you.
Yes, so India had a great head start where IT services was concerned, and the low cost advantage was what propelled the entire IT services industry and led it to grow. However, I believe that the IT services industry and the nature of projects, deals, and the demand that's coming through has undergone a lot of change, and things are getting a lot more complex today. So if you look at just the cost differential post what we've seen in the last few years with high amount of attrition, the salary cost differential which most IT players would have enjoyed has possibly narrowed, and therefore if you look at between on-site and offshore, the differential would have definitely narrowed because there is a demand for skill and talent where there is a shortage. So I think what India really brings to the table in this entire IT journey of companies globally is the fact that they have talent and we have skill. And that's the biggest differentiator. So what I'm saying is that we have graduated from simple offshoring to more complex nature of work, which includes consulting, large-scale transformational projects, etc., where Indian IT services players have a distinct advantage because they have the talent and the skill. And that's something that is helping India to become a more attractive offshoring destination. And I believe that India will continue to enjoy some amount of cost advantage or cost arbitrage, but I think the biggest competitive advantage is the skill and the talent that India possesses in terms of addressing the key needs of companies today. The second question that you asked is about whether the industry would consolidate and whether larger players are better placed. So I think this industry has already seen consolidation. There have been M&A activities, that's been happening over the last few years. And essentially in this industry, scale is also important. So scale begets scale, essentially in this sector. So the larger you grow, your ability to gain a pie of the customer's wallet when it comes to their overall tech spend increases. And therefore, companies which are larger companies clearly are advantageous or in an advantageous position simply because of their size and scale. Also, when you have scale, you are able to offer your client multiple solutions to their problems. So it's not just one vertical that you are looking at. In fact, you are able to essentially help the client in the entire scope of work that the client is looking at, starting from consulting to implementation to the overall testing process. So it's the entire value chain that you bring to the client. And therefore, this is a sector which I do believe that, of course, capability is something that is important, but as you gain scale and capability together, you are actually in a better position. And therefore, larger players which have a wider range of capabilities are clearly better placed. Also, what happens in this sector is that when you are small, you typically do see client concentration, and therefore that exposes you to higher risk because of higher client concentration. As a larger player, you are able to spread across many clients, and therefore client concentration keeps reducing, and therefore reducing your risk in terms of revenue. And the third aspect is, especially when you see uncertainties, most companies would look at vendor consolidation, and then the larger players are better placed vis-a-vis smaller players. Over to you, Aditya.
Yeah, I think thanks again. I think very useful data points, and I think you've touched base. My key takeaway is that you've clearly brought out the element of scale, client risk management. While smaller players would like to have concentrated players, but eventually, I think the future direction should be towards scale and diversifying the risk. I think that's a clear takeaway coming from there. And I think you've reiterated a very important point in terms of skill and talent management. And if I were to use retention as well, I think all go hand in hand. And I think India is definitely the hotbed for talent in terms of as this space expands. So thank you so much for the inputs. And I think we can move again to the next sector. But quick point. Again, here, any budget pointers here for this sector, or anything what I'd quickly share if we move to the next one? Over to you.
Yeah, typically, this is a sector which does not get too much happening on the budget. So, no, not anything that we are really expecting from the budget perspective for IT as a sector.
Sure.
Over to you.
Yeah. So thank you. So which brings us to the next sector from a discussion perspective, and that's an all-time favorite. It's a banking and financial services. So if you see the sector, public sector banks traditionally have the largest number of assets, while regional rural banks have the least. If I were to look at the entire spectrum. So my first question is, how do you see these two contributing to the economy going forward? And will regional rural banks consolidate or stay relevant? That's number one. And if I can combine one more question to that, is that, what would be the other trends apart from, growth in deposits and growth in bank credit affecting this sector? Over to you.
So banking is a sector that's close to my heart because I started my career as a banking analyst. So this is a sector that is very, very close to my heart, and also a sector which is very, very closely linked to the overall economic growth of the country. So let me answer both your questions. So starting with your second question first, actually, in terms of key trends that we are seeing in the sector. So this sector is actually seeing a situation where everything seems to be falling in place, and it's almost like a golden period for the sector. So one, of course, loan growth has picked up, and this loan growth is broad-based. So what was led by retail is now also being led by corporate demand coming back, as well as demand from the SME business banking and smaller segments. So it's fairly broad-based growth. The second aspect, and a trend that we are seeing in the sector is improvement in core profitability for banks and net interest margins. What is driving that is improving in credit deposit ratios and also the ability of banks to pass on interest rate hikes because of the nature of their loan book, which is floating in nature. And the third key aspect is asset quality. And asset quality trends in terms of NPLs have been benign in the retail space. And now even in the corporate segment, we've seen that banks have actually provided for most of their corporate stress. So if you look at growth, profitability, as well as asset quality, which are three key components which drive the overall performance and profitability of the sector, now are seeing trends which are fairly favorable. Now, coming to the question on public sector banks and regional rural banks, obviously these two sub-segments of the banking sector have a pretty important role to play in terms of ensuring that financial services reaches out to a wider spectrum of the economy and reaches out to all corners of the country. So when regional rural banks were set up, they were formed with a specific purpose of providing credit to a certain segment and a sub-segment. And therefore, their overall scope is fairly limited, which is why they have not been able to scale up. And it's unlikely that they will really scale up beyond a point of time. And also the same customer of a regional rural bank, once he moves up in his own credit cycle, will migrate to a larger public sector bank for his credit needs. And therefore, it's very unlikely that RRBs really scale up. And over time, we will see consolidation among the RRBs that are likely to take place. But if you look at their importance, both for public sector banks and regional rural banks in terms of delivering financial services to the broader spectrum of the economy, that importance continues to be there. Thank you. Over to you.
Yeah, thanks. And I think you touched base upon two important points, and I was just kind of penning my notes, and you spoke about asset quality, and I think very important point, transmission of rates. I think the very structure of the loan book you have, probably with the floating rate, it becomes easier. And I think the easier that it is, the more robust or flexible your loan book is. And obviously the element of growth, apart from the key other trends. So thank you so much for your inputs. That was very valuable. And which brings me to the the other two questions concerning the sector, is that if we really look at large players with a wide range of capabilities seem to be gaining ground, right? And kind of a lot of action happening in the fintech space as well. Startups which are in the lending space, so on and so forth. So, do you again expect the industry to consolidate going further, or again, it's an element of scale which needs to be built over time? And if I can combine my last question, which anyways I've been asking you with each sector, is that any kind of challenges facing this sector and any policy support in the budget? Over to you.
Yeah, so when you look at the sector, actually the sector has been growing, as you said, in terms of number of players, different sub-segments which are coming. Again, India is an under-penetrated geography from a financial services perspective. So if you look at credit to GDP ratio in India, which is only about 50%, this is significantly lower than what we have seen even in emerging market countries. So the runway for growth where credit availability in India is concerned is very, very large. Today, you see number of new players and new segments which are actually coming to the fore. So you have obviously the banks, which are your scheduled commercial banks. Within that, you have private PSUs. You have the regional rural banks that we spoke about, and also the old generation private sector banks, and now small finance banks, which is another category that RBI has created. Then you have your NBFCs and your fintech players who are all providing credit. So the runway for growth for each of the segments is fairly large, and therefore there are going to be different players in different categories who are likely to coexist in this kind of an environment and also thrive. But structurally, a trend that we have seen if you look at the last decade, especially where the scheduled commercial banks between private and PSUs are concerned, both in loans and deposits, typically the private banks have gained market share. And even within the private PSU pack, the top 5 banks have gained market share in loans and deposits. And that is a trend that we think will typically continue. Today, you have a situation where obviously banks have seen improvement in profitability, but also their capital positions are far healthier, which will help support their overall growth trajectory. And therefore, in terms of this sector as well, while the number of segments and sub-segments and players have increased and everybody has runway for growth, but typically the share of the top 5 or top 6 large banks will continue to rise. And therefore, in that respect, consolidation is also something that we expect will continue in the sector. Um, in terms of budget, I think again specifically we don't expect anything significant in this budget, but things like how the government plans to tackle the capital requirements for the public sector banks, which is an ongoing challenge. Given the fact that the government continues to be the largest owner in public sector banks, and therefore growth capital requirements which come through, especially in an environment where credit is picking up, that's one thing that we will watch out for. Also, I think one key challenge that the sector faces is the entire evolving regulatory landscape. And therefore, what we have seen is across the last many years, maybe over the decade, the regulatory landscape has been evolving, and that impacts how different players in this sector are able to function. And to give you an example, what we saw recently in insurance as a sector, we saw that the regulator trying to come out and ensure that the regulations are simplified, they are all combined such that it eases the your ability to do business and the ability to grow. So that's something that we would also watch out for in terms of how the regulatory landscape evolves, not specifically this budget per se, but over a period of time from RBI being the regulator for banks per se. Over to you, Aditya.
Yeah, thank you so much for the inputs, and very useful. And this brings us to the last sector that we'd like to cover with you, Shibani, and that would be the home improvement and the real estate space. So if I really look at this particular sector, my first question that comes to mind is that, if you look at the metrics and data, the market size for real estate in India was roughly around 120 billion USD in around 2017. How do you see this shaping up by 2025 and 2030? That's question number one. And if I were to kind of look at, the key market segments here, it's basically the central business district, the secondary business district, Gurgaon and Noida. These are looking promising in terms of net absorption of office space. So within these 4 pockets, which one do you think should be doing well going forward? Over to you.
So if you look at, as you mentioned, the market size for real estate in India, which was about $120 billion in 2017, is now estimated close to roughly about $200 billion. And the expectation is that this segment will continue to see fair amount of growth and demand revival. Again, this is a sector which has gone through various cycles, and we've just come out of a cycle of very low growth, and incrementally growth has come back. So if you look at the demand revival that has taken place in the sector, that is on the back of the fact that there is improvement in affordability. Now, during COVID, interest rates also went down quite sharply, so there were lower interest rates, and policies have also been such that they have helped in terms of cleaning up the sector. And all in all, what we've seen is that the residential real estate demand has started to pick up, and now incrementally even commercial demand is starting to show signs of pickup. As we were discussing in some of the other sectors, this is also a sector which has witnessed significant amount of consolidation, and the larger developers, because of the regulatory changes, have benefited, and therefore listed developers have typically shown sales growth which has been higher than industry average, and that data continues even in the first half of the year. Now, if you look at this combination of improving sales for the large real estate players, market share gains for the organized developers, as well as some improvement in terms of pricing and pricing power coming back and pricing growth coming back in certain pockets, means that there is fair amount of growth runway and for the listed players in terms of their profitability as well. And this is positive for the real estate sector as well as subsectors which are linked to real estate, which include home building. Now, when you look at some of the sub geographies and sub segments that you mentioned, for instance, Gurgaon and Noida, you're right that these two geographies typically look more promising in terms of the net absorption, especially where office space is concerned. But between the two, our belief is that Noida could possibly look a little bit more promising, given the fact that there is a new airport coming up. There are attractive rentals which are lower than what Gurgaon rentals are today, and therefore incrementally you could see some demand pickup because of that. And also there is investments that are taking place by data centers in Noida. So I think all these three factors mean that if you look at a segment between Gurgaon and Noida, Gurgaon saw this great boom over the last few years. But at the margin, it is possible that Noida looks a little bit more promising in terms of net absorption, in terms of office space. Over to you, Aditya.
Sure. Yeah. Thanks once again, and which brings us to my last two questions. Concerning this sector and this interaction, is that how do you see the key trends, especially demand for commercial space, and I think that's a space which frequently clients are always looking out for, especially those who have their own businesses. And second, which is obviously private equity, venture capital investments in real estate over the next 3 to 5 years. How do you see these two trends over the next 3 to 5 years? Over to you.
Yeah, so obviously the office leasing space went through its challenges because of COVID. People moving from offices back to their homes. Many companies gave up a lot of office space as well. But now if you look at data in terms of gross leasing that's taking place across the top 8 cities, that has started to show growth on a YOY basis. And while we are still below pre-pandemic levels, we will be maybe at about 85-90% below at where we were pre-pandemic in terms of office leasing. But incrementally growth is starting to improve. What we've seen anecdotally as well is that most people are now coming back to offices. Even IT companies, which had typically said that they would want, a lot of their workforce being at home or working from home, have now changed their policy, saying that people should come back to work. And therefore, clearly, if you look at what companies are saying in terms of their demand, companies have typically commented positively, and therefore there is optimism that occupancy rates should start to improve. One thing that we would be watchful for is the macro headwinds that we were talking about when we were discussing the IT sector, and near-term challenges, which could delay some amount of companies, in terms of their adoption of new spaces and taking up new space. So that's something that could maybe lead to some amount of delay in the demand for new rentals. But structurally, this should start to improve over a period of time. Now, when you look at private equity investments in real estate, if you look at the calendar year 22, private equity investments in real estate fell almost 16-17%. And that's because of the entire uncertainty created because of geopolitical tensions, inflationary concerns, etc. So across the board, we saw a sharp decline where PE investments are concerned. However, as incrementally inflation normalizes, some of your geopolitical tensions, macro concerns start to abate, you should see some of this coming back. But however, if you look at between commercial as well as residential and retail residential space, the retail housing space appears to be better placed in terms of sharp improvement in demand. Commercial space as well as investments in housing still has a room to go where we were in terms of pre-COVID levels, but at the margin, things seem to be improving. Over to you, Aditya.
Yeah, thanks a lot. I think clearly, I could hear the emphasis on retail housing as a preferred one, seem to be doing better. And my last question, and any expectations from the budget on this sector, Shibani? Over to you.
So I think this sector needs support where affordable housing is concerned. While we have seen growth in affordable housing, I think there is still a lot more that can be done in order to provide housing for all. And therefore, the sector does need support from an affordable housing perspective and, of course, ease of doing business. So I think, I don't know whether the budget will carry this or not, but typically, obviously, the government defined what they consider as affordable housing in terms of both area as well as the price point. But typically, I think from a budget perspective, what we would hope, especially where the sector is concerned, is the government maybe broaden its definition of affordable housing to make sure that housing does reach more. I think that's going to be the key factor that we would watch out from a budget perspective. Over to you.
Yeah. So I think thank you so much, Shibani, for your time, first of all, and to Kotak AMC, for having organized this session. I think this was really very valuable. I think you've been able to attend all the questions in so much detail, and we really like. So with this, we would like to conclude this session, and I would, extend my vote of thanks to you and Kotak Asset Management Company for all the valuable inputs. And as we conclude, maybe any concluding remarks from your side as well before we end this call. Over to you.
Thank you so much, Aditya, for having me. It was really interesting talking about the various sectors, a very interesting set of questions. And I hope my answers and inputs are valuable and help your investors and client base in some form or the other. In conclusion, what I would really like to say is that India seems to be very well placed in a global context. Growth in India clearly is something that is an outlier. And therefore, India is shining, especially in this sort of a scenario where large economies of the world are facing macro challenges on growth, inflation, as well as interest rates. However, we must not forget also at the same time that while we are an oasis in the desert, there is a sandstorm that is blowing, and therefore there could be some impact for India as well. But structurally, we do believe that in the medium term, the India story remains fairly intact. So thank you very much for having me.
Yeah, thank you so much once again. And with this, we can conclude this call. Thank you, Shibani, once again for your time. Have a good day.